All right, well, today started the week on a slightly positive note to the point where the S&P 500 finished the day higher for a fifth straight day, the longest winning streak we've had since January, even as underlying dynamics signal that the market, that there might be some divergence developing here. We talked about that on Friday. That's continuing to be the case today. The S&P again posted a modest gain. The Dow outperformed even while the Nasdaq slipped, just slightly pressured by weakness in some major technology names like Nvidia and Amazon. Meanwhile, healthcare stocks led by AbbVie, with its strong earnings, posted an important offset, provided an important offset there. In a broader landscape, gold rebounded. Oil prices came down, commodities came down, Bitcoin extended its gains. So you're getting a mixed picture here. You're not exactly getting what you would expect from the intermarket relationships with stocks, with the expected stock move. We are moving into a really, really important week for the markets. We have some major earnings reports coming out from these Mag 7 names, some very big economic releases with first quarter GDP and the jobs report at the end of the week. So today's actions may offer some early clues about some positioning from institutions going into the rest of the week. We'll take a closer look at the technical landscape, assess some sector rotations beneath the surface, evaluate whether momentum is building for a sustained breakout or if more caution is warranted. So let's go ahead and get started. Today is Monday, April 28th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching our blog here, be sure to sign up for our newsletter or email, our daily email that we send out here over here on the right. Come down to the bottom, click on this Market Outlook Live button. That takes you to our Market Outlook Live, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market close. Hit this little bell down here in the bottom left to get notified through your browser when these posts are updated. Come down to the bottom, click this heart right there. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, we ended up finishing just a little bit to the upside, about 3 points, 55.25 on Friday, 55.28 today. The other small range, about half the average. Again, that average is coming down, still coming down, and the numbers just continue to be really small. We are above the moving averages. We haven't really necessarily broken through significantly. As you can see, the moving average actually still falling. Again, it was yesterday it was rising. Today it's back to falling. So it's kind of going just sideways here. But the yellow lines and the green line kind of tells you what it's doing. So when you're above it, the line is green when it's rising, and when it's yellow when it's falling. And so that's why, again, you can see it's turned back down again. The momentum line is still relatively neutral. It's in bearish territory, but not strongly in the bearish territory. The near-term line is coming off of an extreme high point that we saw on Friday. The index itself is 1% above the moving average. Remember, it has to get up to that 2.5% mark to really be trending, and that's kind of why we're just stuck here right now. Dark green shading because the intermediate line's in bullish territory. So I mean, that's good. But it's above market sentiment. That's good. And like I said, the near-term line's well in the reversal zone, so that's all good. So those are all really good things. Doesn't help that the momentum line didn't precede it up there, but it doesn't have to. That's kind of the more ideal conditions. So this isn't the most ideal condition, especially considering it's like a bread thrust. But we didn't get that, and that's okay. We just need to see a little bit more follow through here, and the bigger ranges when you're breaking through. Like again, we're breaking through like resistance, and we're not getting big ranges here. The S&P, if you can see, the S&P hasn't quite filled in the rest of that gap. It's coming close, but still hasn't filled in the rest of that gap there. You can see the Nasdaq has. It looks very similar. The intermediate line's above market sentiments and bullish territory. The near-term line strongly bullish. Momentum line's down, but not down strongly. So very similar pattern for the Nasdaq 100. Looking at the Russell 2000, again, the intermediate line's rising. The near-term line's up. It's not very strongly bullish, but you got dark green shading. We're above the market sentiment. We have a yellow line, so this would actually be, for the Russell 2000, a bear tag if it was light green shading, right? Because we would have the light green and the yellow line. So it's similar to what a bear tag would be, like this pattern here, which again can either do one of two things. It can either start the new bullish run to the upside, where we stay above where we stay above the intermediate line or 30-day moving average for a while and start a bullish trend, or it's kind of acts as a resistance, right? We hit it and we fall back down and retest these lows to some degree, whether either it's above it or at it or below it a little bit, but we retest those lows. So that's the Russell. And then your Dow Jones Industrial Average still has not gotten to the moving average, so it's kind of lagging. Its near-term line did not get as strongly bullish. It's just under the 80th percentile there, and the intermediate line is rising above 50. So you have dark green shading. You just have, again, the red line because we're not crossing above the moving average. So the market forecast in all these charts look, especially on the S&P, looks bullish just from this pattern right here. I mean, this has everything you need. The intermediate line rising in the bullish territory, above market sentiment. We're above the moving average, and the near-term line strongly bullish, has everything we need. We're just not really like breaking through is the issue. We're not, we didn't get a bear tag because it's, it was dark green shading already. So you have to have light green shading in a yellow line to get the yellow tag. So the bear tag. So we're not getting the bear tag yet. But in essence, we have. And the problem is, like, once you get that bear tag, so for example, over here, you really want to build on it and get going and get up to that 2.5% mark, if not above it. And ideally, like you saw here, get a cluster to start. And obviously, we're not going to get a cluster until the intermediate line gets above 80. But we need to like build on what we saw yesterday, because that's kind of our breakout day there. Build on what we saw yesterday, and we haven't built on it yet. We're just kind of stalling here at just the 1% mark. So, but again, considering where the near-term line is, there's a good probability and a good chance that we can build on that. Again, barring that that we stay on this near-term run, for an extended period of time, kind of like we did over here. We were on this bullish near-term rally for quite a while. So we got to stay on this for a little bit longer and not falter. And considering smaller ranges and smaller volumes, that's kind of a sign of faltering if we don't, build on this with some bigger moves up to the upside. Especially considering, again, how high the VIX has been here, we should be getting those bigger moves. Obviously, we had a bullish candle, a transition candle last week that was a bullish candle, right? So that leads to a reversal. We got a bullish candle here. We have not. It is a higher close. We haven't closed above that high point yet, the Hakinyashi close. So we're not quite there yet. It is a pretty strong size. You can see if I move this, I can activate it to where we're at now. It's a pretty decent sized candle. In fact, that's about as big as we've seen over the past 3 years. I think this is a 3-year chart. Yeah, past 3 years. It's about as big of a body as we've seen. So interestingly enough, there's been a few, like this one was bigger there and slightly bigger. These two were slightly bigger coming off that October low. Over here we're slightly bigger coming off of the October 2022 low. And these were very big going into the Jackson Hole Smackdown that we had in August of 2022. So it's a pretty decent sized candle. And, again, we don't have a green arrow yet. We kind of need to see that green arrow if we're going to get the reversal. We need to get above these, which means we're above the 10-week moving average. So we're not quite where we want to be. And considering that, we're still in a death cross environment, we need to get above these averages so that we're not anymore. Looking at the 3 green arrow chart, again, we do have 3 green arrows now for a third straight day. The more days that we can get, the better, right? The more likely it is to stick. Now, granted, we're very close to the moving average, so we're very close to not having 3 green arrows. That's why you get the 3 green arrows, or in this case, the bear tag, and you build on it, so it makes it unlikely we drop and lose that green arrow. So that's where, we stay green for an extended period of time. And so we've had it for a couple of days, but we haven't really gotten to the point where we're clearly away from that line. You can see an average range day to the downside tomorrow, and we're easily back below it. And now we don't have it. So we want to keep our eyes really closely peeled. And again, 3 days means that can happen tomorrow. And if it doesn't, if we get a good strong day tomorrow, that can help solidify this with 4 days in a row. And now we're feeling really good about things. You can see it is actually just 1 day for the Russell 2000. This is the first day we're getting the 3 green arrows. And then you can see we're not quite there yet on the Dow. But you can see again, like when you take a look at the 2-line version of this, we're above the point of control, so that's good. But we're still below the 15,200. But hey, we're above the 30. We're above the point of control. Like I said, we're not quite into that all the way in the gap, but most of the way into that gap. The MACD histogram is pretty strong still, getting up to, again, very strong levels. The MACD itself has turned positive. The stochastics is up in the upper reversal zone. You can see the really light volume down there at the downside. We'll come back to that here in just a second. Let's take a look at some of these other oscillators first to see if they're showing some bullish breakout signals. So we need the positive indicator to get above 25 at the very least, and the negative to get below 20, and we don't quite have that yet. So we're not quite there yet on the DMI. We're still kind of showing the potential for this to kind of be a resistance level. We're not above 60 yet on the S&P. I'm still not drawing the red box because we are above 50. But, again, if it falls back below 50, now I'm drawing the red box all the way through. If it gets up to above 60, then I'm going back to this date and starting a green box. And I think that's what we all want. It would be ideal if we were getting above 150 or 200 here on the daily CCI so that we can get the weekly CCI to get back above 100. So we can start the green box there too, and that's not happening. So again, these oscillators are kind of showing that we're kind of at bearish peak levels. Another really good positive thing is we've lost the trend on the trend strength. We had a very mature bearish trend, and we lost the trend. That's a very good sign. The rate of change is still negative and still will be negative for a few more days, maybe another week or so. We're still below the cloud. We're not anywhere close to getting above the cloud yet. So while things are looking promising from that perspective, not quite so promising from these other indicators that we look at all the time. In fact, we're not in the upper quartile of the very big bandwidth. The bands themselves are inside the Keltner channel, so there's opportunity for reversal here with this positive momentum, but there's also opportunity for some failure here in the retests. And again, the indicators are at levels that would suggest that. Doesn't mean that we will actually get a failure and a move back lower. But the smaller ranges, the lower volumes, as I mentioned, here we can take a look at here really quick. The volume was very, very light. In fact, you have to go back quite a ways here into March to get a couple of days of volume that was that low. So very low volume, very low trading range. That's bringing the trading range is coming down. It's still at very high levels at just under 3%. Remember, anything above 2% is very high. The volume is just starting to taper a little bit. And then you look at like the intraday range. Again, we did get a higher high and a higher low. We closed at yesterday's high or Friday's high and last week's high. We didn't quite get above it. So no new 4-week high point. So we're still, now we have both lines below 30 as we have neither a new high nor a new low point here. And you can see we have we're almost there's the rest of that gap that we need to fill in above today's high all the way up to pretty much a new 4-week high point. Because that's the day before the gap to the downside was our 4-week high, and that will be there for another couple of days, right? So this is today, tomorrow, and then the range, and then it drops. So we might get a new jump on the green line just by default, right? Now what we don't want to see is to get a jump. So it's a jump like this, where you're in a bullish, in this case, a bullish trend. You get a 1-day jump on the red line, and then we maintain the bullish trend. So the opposite would be, let's see, I might have to go back to 2022 for an example here. But the opposite would be that we come up and we get a one-day bullish trend. So like this May period, this was that period where, again, we barely missed the Zweig thrust. I talked to you about that last week. Well, we had a one touch on the green line there. Didn't quite get to 100 because, we never did form the new high point. So that's what would happen this time. Is what that green, if we don't get a new high in the next day or two, we're going to get a new high, right? Because this will be the new high. So even if we falter in the next day or two, like that will be the new high. So your green line's going to jump. Everyone's not going to jump all the way to 100, but it's going to jump. And the last thing we want is a one touch, right? Because I told you one touches are really bullish when it's a red line one touch. They're pretty bearish, and they happen during these kind of pullbacks and this was actually in the 2023 pullback there, but they can be really bearish when they're green line one touches, and that's what we would be susceptible to if we don't we don't continue to move up here and get the new high on the day, right? On this, whatever day, whether it's tomorrow or the day after. If we're not getting new highs on those days, then this becomes the high, and now we're really susceptible to, again, a one touch where we don't get another new high because we're going to be trading down in this range. If you take a look at where we're at here on this chart, again, we're at the 80th percentile. So again, we're at bearish peak levels. We need to get up above, and especially above 90 would be the most ideal to really solidify, a new bullish move like we see on all these other instances. All right, finally, let's take a look at the VIX. The VIX, of course, is down. It's not surprising. We're at 25. We are below 100%. Very good sign for the VIX. We did not get back below 100, though. Remember, I told you when the VVIX drops as much as it has in such a short amount of time, it generally leads to a pretty big jump in the VIX. So that's something we need to be watching for over the course of this next week. With all the things that are on the calendar, that's something we need to be watching for to see if it has an impact in getting the VIX itself up above its own averages, right? If it gets back, here it's at the 50-day average. If it gets back above these averages here, is the big drop in the VVIX going to spark the VIX to move up off of that average value line or not? And that remains to be seen. That's kind of something I'm looking for and expecting, actually, because of the past precedent of such large VVIX declines usually leads to big moves to the upside, even if they're just temporary, but relatively big moves to the upside in the VIX. And we don't need it to be, a huge move up to 80 plus, right? Just getting up to 43, which, again, would be a 60% jump in volatility from these levels, but getting into the low 40s would definitely mean that we'd be retesting that washout low point and making our last leg lower. With that last green tag, we got a great green tag now, 7% now. But one more red tag, whatever that would be. If the VIX were to get up to 43, that means we're getting another red tag before this correction is finally over with, and we can move on to stage 4. All right, now let's talk about what's driving the price action today from an intermarket standpoint. And again, it's really interesting to see here. Let me zoom in on just today because it wasn't a very typical day. I'll show you why. So again, gold was up significantly. The dollar was down. Commodities were down. And bonds were up. Yields were down. So that's been the trend here. So since the S&P peaked in early February. So here, let's pull up this. So this is when we peaked in early February, right? So from that point, you can see February the 10th on the 10-year yield. All right, so February the 10th would be right in, if my cursor would stop moving around on me, right about in this area here. Like yields fell for the most part during that, and we fell again today, the 4.216. If I were to take a look at the 10-year yield, or the dollar, excuse me, let's look at the dollar. From February the 10th. So here's February the 10th. So you can see from this move here, we've generally been down, and dollar was down again today. That's been bearish for equities, and bearish. That's not bear. It wasn't bearish today. If you look at gold, kind of bear. The market still ended up finishing higher. You can see gold was high because of the weakness in the dollar. Gold was higher here. Again, my computer's being a little slow, but if I were to come over here, finally I can move my cursor is like delayed because something's working in the background here, I'm imagining. But you can see gold went up from around my cursor. I'm not going to be able to get there. It's going to take me an hour to move it there. But you can see gold's been up. If I take a look at commodity prices during this period of time, commodities were down today along with the dollar. And you can see commodities have been on a pretty steady downward trend since early February. So it's like, so all these factors would suggest, you know, gold up, commodities and the dollar down, bonds up, yields down. All of these would suggest that weakness in stocks, and that was the case for most of the day today. The S&P was down 1%, the Qs were down 1.25%, IWM was down 0.75%. So that was the case for most of the day, but not by the end of the day. And you think, okay, well that probably means by the end of the day, bonds fell. Nope. Gold fell, and the dollar rallied. Nope. Commodities rallied a little bit, but still, I mean, clearly down. Below equities here, underperforming equities. So not necessarily. It was a nice little rebound into the close. I think it was more of a rebound into the close in anticipation of, like I said, a very, very busy, like I said earlier, a very busy week on the calendar. And that was it. But you can see that the intermarket relationships that typically puts pressure on equities did put pressure on equities in the early portion of this session. But one thing that's still a really big positive is the breadth. The breadth looked really, really good today. The McClellan oscillator was up at 90 earlier in the day today. You know, it hit 78. It's down to 67. So a little poor there at the end of the day from a breadth standpoint. If I take a look here, let's take a look at the breadth indicators here. So give me 1 second to pull these up. Not the survey results. Where is it? Everything's moved on me here. Here we go. Let's take a look at the breadth results on this. Move this over here. Give it a second to load up. All right, let's try this again. We'll go to, let's start off with the number of stocks above the 50-day moving average. You know, it's a pretty decent number. Again, not above, we're still in bearish territory. We're not back above 200 yet. We're above the average, but we're not above the 20-day average, but we're not above 200. The number of stocks above the 200-day moving average. Again, same level, 177 above the average, but not above the midpoint of the range, nor are we above 200. Of course, that means the ratio here has come down to 1, right around 1, and hasn't really broken yet up above that level, which is, you know, again, when you're coming off these major lows, you want a big time breakdown to the downside. If, you know, that was the 2023 low point. You can see some of these other, here was the move off of the June, July, where we had a big drop down there. Same thing here, we had a big drop down there coming off the October low point, well below 1. You know, what we don't want to see is, like, you can see some of these peaks occur when you just get, like, if you're just getting a little bit below 1, that's when the peaks occur. And some of these, same thing, you get below 1, that's when the peaks occur. And, you know, right now, I don't think necessarily that's what we want to see. You can see over here, we dip below 1 a little bit. That happened to be during a peak. We don't want a little bit of a drop, right? We want a significant drop below 1, which means that we're getting a lot of stocks breaking it back above the 50-day moving average, and that's not happening yet. And the other big problem, too, with our breadth is the net new highs and lows continue to be very poor. If you take a look at the actual number here, let's see if it's been updated. Yeah, I mean, look, we're at 115 versus 75, so, you know, right around the 40s, and that's, you know, that's where we're at, and we can't be. We need to be above 100, right? We need to be a positive 100 or higher for us to be really good about this bullishness, and so we're not quite getting the breadth yet that we want to see, is, you know, as well as the money flow, again, is still, you know, the oscillator itself is getting up to bullish levels, but this indicator not quite getting to where we want to be, which is actually about right here. If I were looking at the same price levels, we're at the same price level that we were back in March 13th. So if I'm looking at the volume level or the money flow level on March 13th, we're still easily below that. So again, not getting the breadth that we want to see that to really, again, give us escape velocity, nor some of these other indicators that we also want to see as well. And if I take a look at the sector rotation moves here today, let's take a look at the sector comparison chart. And we'll just look at today. You can see, not surprising to see over the last 3 months, the safety trades outperforming during a period of decline in the markets. But if you look at today's move, it was led by energy, real estate, and utilities. I mean, that's not the three-headed monster we want to see, right? You can see during the decline, it was led downward by technology and discretionary, and they rallied really well to the upside, but they finished lower than the markets. And again, that's not the leadership we want to see. That's more of a, when those stocks are outperforming the markets, then they tend to be negatively correlated to the S&P 500, which means they tend to outperform, especially like against XLK. When you look at the ratio there, let's take a look at a ratio of, we'll go XLK to XLE because that's kind of a good ratio of, here, let's see, let's put it on, there we go, that's what I want to see. So let's put it on so I can have that correlation there. Let's look at XLK to XLE. Again, when XLK is outperforming XLE, the markets tend to do well, right? That's the positive correlation. And we've had a good jump back up to the 200-day moving average of this ratio. And you can see starting to get a little bit of lower highs developing on a lot of these indicators, and the prospects of us is starting to underperform because energy is leading technology, and that's not a ratio that we, that is associated with risk appetite. It's actually, interestingly enough, associated with risk aversion instead. All right, well, that brings us to our trade idea of the day, which actually kind of happens to be in the technology and discretionary space, and it's actually on Expedia. Let's take a look at Expedia here. One second. It looks just like the market, right? It's got kind of a quasi bear tag situation going on here. It's kind of sideways, intermediate lines, rising above the chart's midpoint. The near-term line's not that strongly bullish. But it is bullish. The momentum line's bearish, but not that strongly bearish. You can see we're above the moving average, but just barely there. Looking at the let's look at the weekly chart first. And you can see, okay, we got kind of a bullish candle like the S&P 500, but not that strong going into an earnings announcement. Very much smaller body compared to what the S&P, and we're in this golden cross environment, haven't really crossed below it yet into a death cross situation quite yet. Let's take a look at the 3 green arrow chart. Again, low volume, relatively small range, below half the range. We're sitting right at the 200-day moving average there, but above the short term, still below the long term, intermediate term moving averages. And then you'll see some neutral signs in pretty much all of these other oscillators here, both the positive and negative, and now the ADX lines are all below 25, between 25 and 20 and 25. When you look at the RSI, it's above 50. The CCI is above 100, but not above 150. So kind of the exact same that we talked about there for the S&P. And then finally looking at the Bollinger Bands and the Keltner channels, you can see we have a change to some small positive momentum. The bands are inside the Keltner channels. We are in the upper half of the bandwidth that's declining now, but not in the upper quartile. So it doesn't look like we're breaking out to the upside anytime soon. So what I decided to do on this is kind of a similar trade to what we've been doing here lately in quite a few trades, and that is to do an iron condor spread. So we sold the low 20 deltas on the put side, sold what was the low 20 delta here on the call side. This moved up, but was our call side 2. So that gives us our typical iron condor setup. We don't go full position size because of the earnings, because there's risk involved with that earnings announcement coming up. But what that means is that we can still get a normal return. We'll just do it with less risk than our normal return because of the higher volatility associated with that earnings. And you can see the bandwidth is completely inside of the break evens, and you can see those lots of touches here at the lower break even, lots of touches pretty much at the upper break even. So that's probably the one that we're probably most worried about, is that upper break even if the stock were to take off and earnings to a new trend. But again, we're compensated for that by having less at risk to get our normal return there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.